Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. All right. Super excited to have another one of our episodes of the Investor Podcast. Really excited to have one of my guests today. His name is Sequoia Borgman. He's the founder and CEO of Borgman Capital, an investment firm specializing in acquiring major interest in well-established, closely held lower middle market companies. This is a role that he's held since October 2017 with more than 2 decades of experience in M&A, including structuring, planning, due diligence, and Sequoia just really brings extensive expertise to the firm. Before founding Borgman Capital, he was a partner and practice leader at RSM. They're a leading multinational global accounting firm. Before that, he was a managing director at KPMG. And just throughout his career, he's advised on numerous complex transactions for both public and private market firms. So a lot of that, I'm assuming, has kind of led him to kind of being able to build something and build an institutional firm. He holds a master's and a bachelor's degree in accounting from East Carolina University, and also he's an inactive certified public accountant and actively contributes to the community by serving on the boards of various public companies, private companies, nonprofit organizations, and professional associations. So Sequoia, thanks for coming on. Hopefully that was a good, high level intro, and excited to go further and dig deeper.
Yeah, no, I appreciate you having me on the show. Yeah, I think you hit all the high points.
Yeah, appreciate it. Well, there's a lot of other points that I think are going to add a lot of color, but what I always like to do is kind of learn a little more about your early career. So I think having that accounting foundation is a really great foundation. And oftentimes we see those people, move to the fund admin side or, the fund audit side. So it's really interesting to kind of see you kind of really move over to the buy side. So walk me through kind of your early career, what you thought you were going to do in college, and how that eventually kind of evolved to kind of not only getting into the buy side, but now building your own investment firm, kind of supporting, middle market PE.
Yeah, I think it's a little unique coming from the CPA accounting side. Most people in private equity started in investment banking and then moved over to the investment side. But yeah, like you said, I originally I was a finance major in undergrad, and when I was coming out of school in the late 90s, there was a lot of roll-ups in the banks. There's states that deregulate them, and there just wasn't a lot of jobs in the finance sector. So I transferred over to accounting and got my master's in accounting, and started out with at the time one of the largest firms in the world was Arthur Andersen. I started there. Great training, great spot to start your career. Any of those big organizations, you really can't beat it. And spent 18 years in public accounting. That's where I got introduced to kind of the deal side, transactions. Worked on a lot of big international and national acquisitions and mergers. And then towards the end of my career, I'd joined RSM. That's where I really got introduced to kind of lower end of the middle market and a lot of the middle market firms out there doing deals. And I'd been a partner for a long time and was ready to do something a little bit more entrepreneurial. That's why I launched the firm almost a decade ago now, really investing in these nice lower middle market companies all around the country.
What are some of the sectors that you like getting involved in? We see a lot of people kind of now getting into home services and, HVAC and plumbing. So do you feel that there's a lot of opportunity when it comes to middle market focusing on those sectors, or are there other sectors that you just really feel more comfortable, being a market leader in?
Yeah, I think the service sector is very popular right now. Everybody's a little concerned about AI and think that residential and commercial services is a good space to be in. We tend to stay away from those businesses, though. Those are really people businesses and all about the leaders.
Sure.
So it's a very, very high risk if you don't have the right person running those organizations and doing the integrations on the roll up. We tend to be more value investors. We're investing in older industrial businesses, more manufacturing, distribution. We've bought a couple equipment dealers. We've bought quite a few food businesses at this time. We've done well in those spaces, but those are more kind of established, a lot of family businesses, entrepreneur-led businesses, but companies have been around 50, 60, 70 years, have an established business model, maybe more of an older industrial focus, but at the end of the day, we're value investors, so we're buying these types of businesses that aren't getting the double-digit multiples like some of the sectors that are hot.
What type of like ARR and EBITDA do you like to get into? Walk us through kind of a typical deal that kind of hits a sweet spot for you.
Yeah, our sweet spot is lower into the middle market, so I'd say between 4 and 8 million of EBITDA is probably the majority of our deals. We've done some bigger deals up to 15, 16 million of EBITDA, and we've done a couple under 4 million EBITDA, but I'd say to have a little bit decent size and then stay under the really competitive kind of professional investment banked auction processes that once you get to 10 or 15 million of EBITDA, those are just a little bit more competitive than really what we want to spend time on.
Sure. And then when you think about 4 to 8 million in EBITDA, you're probably thinking at least maybe 25 to 50 million in top line.
Yeah, I'd say at least 20 million in top line, somewhere between 20 to 100, 150 million is the majority of our businesses.
And then that's interesting. So the food businesses, what are some type of businesses that you like on the food and family? Are they catering companies, restaurants, or are they just more mass distribution of food to restaurants? I guess what's kind of the sector that you're interested in double clicking on that?
They're primarily manufacturing or packaging businesses in the food space. We've got 5 offices around the country, but our main office is here in Milwaukee, in Wisconsin. So we own a cheese company. You've got to, if you're in Wisconsin, you have to have some investment in cheese space, and that's been a great investment for us.
Sure.
And those are the types of businesses that was owned by a husband and wife, closely held business that had grown it to a nice size, and we're looking for kind of an exit, and it was just perfect fit for where we invest.
Yeah,
shout out cheese.
Yeah, I was gonna give a shout out to Dave Soxy. He lives in Wisconsin. I don't know if you know his family, but I think his family office owns I think they own like a butcher facility, and I think they have a grocery store as well. But I don't know if you know those guys. But he's based in Wisconsin. He's built pretty interesting community of family offices. But he's kind of like somebody I would think of. His family, multifamily generation that's kind of built a couple different businesses. What do you look for when you're thinking to acquire one of these types of businesses? Maybe on the qualitative side, what are some things that you check the box on when you're looking at the founder and maybe the family that's eventually going to be helping to support the transition? And then, outside of just kind of the financial metrics, what are some other things that you look at in terms of like it being a healthy business?
Yeah, well, I mean, you said I have the accounting background. We're pretty conservative, so the numbers are the number one thing. We look about 1,500 businesses a year to buy 2, 3, 4 businesses. So it really has to have strong cash flow. I mean, we're a traditional leverage buyout model, so the business has to be able to service that debt. So it can't be real cyclical, or it can't really have cash flow that you can't really rely on. So those types of businesses we pass on. But if it's steady, nice, proven business model, good management team, those are businesses we dig in on. And then the number one thing before we go forward is really a trust between the seller and us. We want a seller that really cares about their company, cares about their employees, cares about the community. Those companies tend to do better after a transaction once we get involved. So we really have to be aligned with that seller, know that they want what's best in the best interest of the business. And if that's the case, those are the types of businesses we really pursue.
Sure. No, that's great. And what would you say are some of the qualitative and quantitative skills that make a good investor, especially if you're looking to hire somebody to kind of expand your team? What do you think the qualities are of a good buy side, essentially buyout manager?
Yeah, I think the analytical side is key, but there's a lot of people with good analytical skill. I think somebody with some intellectual curiosity. Every business is different, every culture is different, every business model is different. So you really have to truly sit down and understand how that business makes money, where their value is, where value creation can be added, and that takes somebody that's just a constant learner, somebody that's really intellectually curious, that enjoys talking to business owners, talking to management teams, really digging in, doing the research, reading whatever's required to really understand that sector and that business. I think that's more important than really the analytical skills, which, like I said, a lot of people have those. They can do all the modeling all day long, but the really truly understanding the risks in a business, I think, is key.
Sure. No, that's really helpful. We've had several middle market and also just larger buyout firms on our podcast, and a lot of them have started to talk about using AI. Some of them have gone as far as replacing maybe an analyst with just AI to kind of just put together a memo really quickly. So, I'm assuming there's probably some of that going on because you told me you talked to 1,500 companies and screened them at least. So there's got to be some pipes underneath kind of doing some of that for you, I'm assuming. But where do you see kind of AI fitting into your sourcing, screening kind of technology stack to kind of augment some of your workflows? Or do you feel you're not ready to take that on right now because of the type of businesses that you're looking at? Would love to see how you're looking at AI and how that's going to evolve to support, you being more efficient.
Yeah, like everybody, we've definitely been spending a lot of time focused on AI, encouraging the whole team to use it as much as possible. We've got quite a few tools in place at this point, and there is some tools that'll take on some of the analytical and kind of lower level skills. It's not perfect. I don't think we haven't replaced anybody. I mean, it's made everybody's roles and jobs streamlined and easier. I know personally it's freed up some of my time to really focus on bigger picture and a higher level strategy stuff, but I haven't seen any real value creation at this point. We've been encouraging the portfolio to use it quite a bit, and there are some areas that it's good at, quoting and some of the back office stuff and some of the sales portions of the business, but I haven't seen any real return on those investments. I think we're a little early, at least in our sector. I think some of the more technology focused businesses are getting some better return, but the older industry, manufacturing, I think it's coming though. I think in the next 12, 24 months, we'll start to see some returns on those investments.
Where do you see the future of manufacturing heading? With kind of the investments that you made, do you see kind of some technologies that are going to streamline some of those processes?
Yeah, the manufacturing, I mean, there's been a lot of focus on automation and robotics and AI for years. So I think it's a slower process. I think that'll probably be one of the last places that AI really takes over once some of this new robotic technology is really pushed down their lower middle market. I mean, it's being used now at the Amazons of the world, but it takes a while to really roll downhill to where you have to get return on that investment in order to, if we're paying 10 times for a business, you spend $1, you need 10 to get a 10-time return on that dollar. So that's kind of where we're at right now. And those costs just haven't aligned to this point.
Yeah. I mean, the craziest thing that I saw on my feed recently was a robotics company that's been renting several Airbnbs, and they just kind of rent the Airbnbs. They haul in a bunch of robots, and they're training the robots on the models to do home tasks. And a lot of these Airbnbs are getting completely damaged. Like there's crazy scratches and dents on the kitchen counters and the washing machines, and they're essentially training these robots to learn how to wash dishes, how to clean the house, and in the process of that, obviously there's large amounts of damage. So some of these Airbnb hosts are reporting these people and sending them like $15,000-$20,000 invoices, and these companies are just paying it. They're just paying for the damage, because if you think about it, that's the biggest data set to train home tests, right? I mean, if you really want to kind of learn how to do those things, you need some type of environment where you can do that at scale, and the only way that you can do that obviously is through kind of checking into these type of these venues. You could probably set up some massive warehouse and simulate it. But that was kind of the craziest thing that I've seen in terms of just training models and just kind of getting these robots to kind of align with the algorithms as they're learning and improving. So I thought that was kind of interesting. And then for me too, just kind of thinking through physical AI and just how people like Jeff Bezos and now Travis Kalanick, they're building businesses to kind of really think through how AI can kind of get integrated into the physical world. I think for me, that's been pretty interesting. So I wanted to hear your thoughts on that. As kind of AI is kind of integrating in at the edge and being able to still run algorithms offline. I don't know if you've been seeing any of that kind of stuff as well.
Yeah, I think it's an interesting space for sure. I just think it's going to take a lot longer in the 3D world. I think the white collar roles and engineering and a lot of the programming stuff. I mean, there's data out there that the AI can train on to learn how to do those roles. But yeah, like going and making a bed or folding laundry, that kind of stuff. I mean, each one, that robot has to be trained to do that, each process. And once you train the robot, though, every robot has that same knowledge. So I think, it's no different than these autonomous cars. I mean, that's taken a lot longer to come to market than anybody thought. I mean, 10 years ago, everybody thought there'd be self-driving cars all over the roads, and it's coming, but it took, each one of those roads, each one of those turns, everything, that took a lot of training to train those models, and all these physical roles and factory roles and manufacturing roles. They have to be trained, and at some point they will be there, but I'm not sure if it's a year out or 10 years out.
Yeah, I mean, we're seeing Waymos in New York City. I'm in New York, and none of the Waymos I've seen have been unmanned. I've seen a handful of them in San Francisco. I think it's pretty standard in the downtown San Francisco area, but I feel like they're still, because I see humans in the Waymos now, to your point, they're probably still training them. So I think it's going to take time, and you'll be surprised what you can achieve, like Bill Gates said, what you can achieve in a decade. But it's still going to take multiple years to kind of evolve those algos. Another thing that I think would be really helpful is just your advice for new fund managers that are kind of trying to maybe pivot into asset management from another discipline, and then talk to us about kind of advice that you have on the next step, which is like, how do you build a firm? I'd assume you'd want to kind of build some of those skills, learn how to be an investor at a firm and get some work experience. But then, how do you kind of think from a mindset of, being an employee or being an investor to now a fund manager managing capital? Any words of wisdom for people kind of making both of those shifts?
Yeah, I think right now it's difficult. Fortunately, when I launched in 2017, it was a great time to raise capital. There was plenty of liquidity out there, a lot of money going into private equity. Times have changed. It's a lot more difficult now. A lot more of the capital's getting aggregated among the very large fund managers. There's less liquidity, so a lot of the LPs are not supporting new fund managers. But for good investments, everybody's always looking for good investments. So really, you've got to have a great investment thesis. You really have to have a niche. And if you do that, it may take longer to raise the capital than it did in the teens or 10 years ago. But there's always money available for good investments. So that's the main thing. Make sure you focus on an area that you can get the returns and build up that track record.
How do you differentiate yourself? So if you're a middle market private equity fund manager, what are some ways that that you've seen has helped you kind of just stand out and really kind of help that story resonate with LPs?
Yeah, I mean, the most successful ones have really focused on one niche, one segment
Mhm.
that has done well. So
Sure.
timing and being in the right place, right time really helps. We've been more of a generalist, more
Sure.
opportunistic. Our focus is really more these really nice, established, cash flowing family businesses more than any one industry, one segment, one geography. We'll go wherever the deal is, wherever it is in the country. And I think, and that's been successful for us. And we've got a 10-year track record. We've had some very successful exits, so that helps at this point. But when you're first starting off, it's hard. I mean, my
Mhm.
first couple deals was very very difficult, and you just got to be successful on those. As a new fund manager, you've got to make the right investments. Don't just buy what's out there just
Sure.
because you want to get a deal done. You've still got to be very very disciplined and selective of what you go after,
Mhm.
and I think that's key.
Yeah, no, it's really helpful. You talked about integration. So when you acquire a business, what I think is interesting is how much more of an integration or how much more of a lift that you have to add. Do you like to kind of come in when it's already kind of humming and there isn't much to optimize, or do you like to come in and actually make some changes and really optimize and increase the EBITDA over time? I guess how much of a turnaround do you like to come in at with the kind of investments in the stage that you're getting in?
Yeah, we don't do turnarounds or restructuring or anything that's really a broken model that we have to fix. We're just
Yeah,
buying nice companies, but those family businesses that we're buying, they all have to be professionalized. You have to put systems in place, bring in professional management, put processes in place, systems, and do a lot of that heavy lifting to get it ready for the next level of firm that really doesn't want to roll up their sleeves and invest that time and energy.
sure.
Um, and that's our value creation.
Yeah.
So that's
So
why
there
we're
still
paying.
is that involvement. I mean, I guess you call that the integration where you come in and add a lot of those systems, those automation and modernization to kind of get it to probably the next tranche of EBITDA to hopefully, get you that serious hopefully distribution DPI at the company level, right? And then the company level is going to drive the fund level returns with that
Yeah,
value creation, I'm assuming, right?
yeah, that's a lot of the value creation at our level. A lot of the biggest
Mhm.
risk is transitioning from a family or founder owner to more of a professional management team,
Mhm.
and a lot of investors don't want to take that risk. So
Sure.
we'll do that. We'll make sure that that goes smooth, and then we'll sell to maybe a bigger fund or a strategic or a public company out there
Mhm.
that already wants something that has all of that heavy lifting already taken care of.
Sure. What are some of the challenges and, processes that you've built to address that specific issue, transitioning from a family to kind of now building a professional team? I'm assuming it's SOPs, but how long do you like to have the family still involved to kind of help with that transition?
It kind of depends on the transaction, but
Mhm.
we like to have them still have skin in the game. We want their interest aligned with ours. A lot of times they'll sit on the board and be involved even after they transition. A lot of times they'll stay around for a year or two and run the business,
Mhm.
and help us pick the right successor for the business. So we like it when they want the company to continue to be successful and thrive. That's really our focus. So we try and work with the sellers as much as possible because we know that is the risk. The risk is you bring in the wrong president, the wrong leader of that business, that either culturally they don't fit, or they just don't have what it takes to run that business.
Yeah, no, that's helpful. And then when you think about kind of the exit, it's pretty interesting how you're already thinking about the acquire or the business. How can buyout firms kind of really think through mapping that out? As they acquire the business, how can you kind of think through a couple of those different options in terms of getting to liquidity and having a healthy multiple?
Yeah, we try and run the businesses like we're going to own them for the long term. You make the
Yeah.
investments as, I mean, these businesses were built over 50 or 100 years. They
Hmm.
don't turn around in a year or 2 years. Sometimes
Yeah.
they do, and you make you find some good levers to pull, but that's more the exception than the rule. And timing, you can't really time an exit. Like right now is not a great time for exits. And there's a lot of
Yeah.
people that bought companies in 2020, 2021, 2022 that would love to be exiting right now.
Yeah.
And that was probably part of their business plan, but you can't really exit in a down market or where there's not a lot of opportunities. You have to run the business as if you're holding it for a long period of time. And our number one priority is to do whatever's in the best interest of our LPs and our investors. And so we usually exit when we're really exceeding our investment thesis in that business, and it's going to be a really nice return, or we have somebody reach out to us, or several potential acquirers reach out to us. We know that means it's a good time to exit that business, and we'll hire an investment banker and go through a process.
Yeah, it's helpful. And then, as you are screening these 1,500 companies, can you walk through at just a very high level how you prioritize and, decide which ones go to IC? You probably have a huge database and, obviously your checklist of criteria, but what is it about the business that shortlists them to kind of finally make it to IC? And then when you go to IC, would love some guidance on just kind of best practices to hold an IC and make that final decision. Because obviously there's a limited pool of capital and you really have to make sure that you're making the right decision.
Well, there's a limited pool of capital, but it is also very competitive. I mean, the best companies have plenty of buyers. We sold a company earlier this year, and I think we had 40 bids for that business.
Wow.
So I tend to spend my time on something that I feel like we have an angle or something where we have a higher likelihood of winning that process, or really connecting with that seller. That's probably the number one. We probably talk about 10 or maybe 20 businesses a week, and the ones I spend the most time on are those that I feel like we have a higher likelihood of winning. If there's only a 1% chance of winning, I don't want to spend couple days going and visiting that business, spend $5,000 on travel and hotels and dinners and all that kind of stuff if there's really very little likelihood that we're going to win. So first off, I think it's got to be something that we like, that meets our kind of cash flow and financial metrics, but also a likelihood that we have an angle where we can win.
Sure. And what are some of the best pipelines for just deal flow? I know a lot of people just focus on relationships. Are there trade shows that you think are great, or online databases that you think are helpful to kind of, build these pipelines with great portfolio companies? You told me they're super competitive. And I know there's a couple out there that you can, go into and log in, and some of them have subscriptions, but what's worked for you in terms of just getting access to the best deals?
Yeah, I think the best deals come through our network. There's where somebody introduces us. We've got 5 locations around the country, and I feel like it's key to sit in those markets where your friend introduces you to somebody that wants to sell their business, or your financial advisor or some COI introduces you. Those are the best opportunities. But every person on our team, we've got 15 people, are incentivized to do cold outreach and work all the trade shows and the industry shows. We hire buy-side brokers to do searches. We use marketing firms, a lot of SEO stuff. The podcasts like this, this really helps get the name out there. Sure. I get a lot of people reaching out to me through LinkedIn that want to sell or know somebody that wants to sell. You really have to do a little bit of everything to find good opportunities.
Well, Sequoia, I appreciate all the good work. I'll definitely share all the good work with our community on all of our channels. So really appreciate it. I always end every podcast with just one piece of advice. It could be from an advisor, it could be from a mentor, a family member, and it doesn't have to be professional. It could just be about life advice. So whatever you got for us, we'll take that back with us.
Yeah, one thing I tell my team quite a bit, I don't know where I first heard it, was just do what you say you're going to do the right thing. A lot of people's livelihood and their families rely on us. Hundreds and thousands of people. So at the end of the day, do the right thing. if things don't go as expected, just make it right. And I think that's a good philosophy to live by.
Yeah. Well, great advice, and learned a lot, and so will our community. So thank you so much, Sequoia, and everybody else. Have a great weekend.
All right. Thank you. Have a good weekend.
Take care. Bye.
Bye.
And how global markets are driving capital allocation. So join us on this journey as we explore these insights.